Hello traders, Gary Wagner here. Just about 10:30 in Honolulu, 4:30 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 25th day of April, 2014, and this is the daily report for gold and silver, our weekend review, and we are ending this week on a bang as we see sharply higher pricing for the second day in the row across the board in the precious metals markets. Gold currently trading roughly 1302.14. The low has been 1289.60. The high 1306.40. We will talk about our current trade in just a moment. Silver also tracking higher, but in terms of percentage gain, roughly half of what we're seeing in gold. Silver up 0.33%, gold up 0.66%. Current print on the screen, 1970. It has had a low of 1945 and a high of 1992. More on silver towards the end of the show. I wanted to start today's show and review by taking a look at the setup, the signal that we issued yesterday. We issued another signal today. We're looking at a daily chart. I've put this daily chart so that it ends on Wednesday with this little doji. And as the market was coming down, we want to think about the setup itself. We were looking for the market to run to roughly the 61% retracement level. And that retracement level, of course, is off of this major $200 rally. The fact that it would come down about 61% in some sort of an ABC is really what we were looking for. But we really needed to see some sort of sign that we were getting a waning or a weakening of the current corrective action that we saw. Of course, as this market, this is our B wave here, and as this market came up, we forecast that we would see this market move to anywhere between 1333 and I believe 1362. So in terms of the band or the area, it would have been roughly, let's say, right around here was the band that we were looking for. The actual high that it came to was 3250. So just to approximately 50%, then it starts tracking and trading lower. The real first indication we got that something might be happening, and we've seen it before, but nothing actualized, because you can see this doji here. This is Monday, Tuesday, Wednesday. We get this doji, and my thoughts at that point were we were nearing the 61% retracement level. We hadn't quite gotten there. However, we had just seen really the first two candles forming of a three-river morning star. And on a three-river morning star, of course, you get a red candle, a star, and then a large green candle. So my thought was that we could possibly see this market unfold with that pattern present. However, we still didn't tackle or hit this 61% retracement level. I wasn't really comfortable. Now, the following day, this is yesterday or Thursday, and let's move it over just a little bit. We got this long green candle with the star gapped below it. We had a really almost a textbook three-river morning star, except for one fact, and that fact was that this low, you typically want to see the green candle with a higher high. Of course, your low shouldn't really be down in this area, but this is how the market panned out. We had an extremely volatile market, but lo and behold, when we saw that, we also took note of the fact that we had actually now come really close to our actual 61% target. So this is yesterday, of course, and I put out a trade recommendation to buy or enter the market from the long side, placing stops below a 1268. 1268 is this low that you're looking at right here. But I also labeled it as an aggressive signal. Now, an aggressive signal was issued because of the fact that we did not get our confirming candle, especially when we're using a daily chart like this. conservative traders want to wait till it confirms, and a confirming candle is going to be a green candle with a higher high and a higher low. Now, traders that took this call got in roughly at about 1292 because the market was trading 1291 to 1293 when the call was actually placed. Lo and behold, today, as the market started trading, of course, overseas it opened slightly lower, was trading $1 off to $1 higher. As it went into London, the same thing. But as London was beginning to close and New York was getting ready to open, we saw this market start to react, and we saw the market actually form this confirming candle. So it was on this confirming candle right here that we issued our conservative buy signal. Now, traders that took that call were in roughly 1299 to 1300 because that's where the market was. We had really issued this recommendation about an hour before New York opened this morning. At this point, all traders that do wish to participate should be long the market. You're going to be long depending on whether you take the aggressive or the conservative signal, either at 1292 or call it 1299, 1300. Now, I did receive an email and I was asked whether we track or we take the conservative or the aggressive call. And to answer that directly, we will typically, almost always actually, take the aggressive call. What I've found over time is that taking the aggressive call, you're going to get a few more trades that don't pan out, in other words, that are drawdowns. However, by taking the aggressive calls for the trades that do pan out, it places you in a much more favorable position in terms of pricing, and your profit potential and structure is much higher. And I found that if you weigh that over a year of trading, what you'll find is it will far outweigh the losses that you might incur by taking a call, an aggressive call that doesn't actually pan out. What do I mean by pan out? Well, what I mean is that we got our confirming candle, that's right here. However, if the following day, meaning today, had been a red candle with a lower low or a red candle with a lower high, such as this illustration, then it negates the particular pattern itself. And therefore, what you see is a incomplete pattern because you don't get the confirming candle with it. And to give you an idea where we might see that occurrence, I'll try to look for it. Well, here the market hadn't really been coming down, but if you take a look, for example, right in this area, you've got a red candle, you've got your star, and then you've got your green candle. Following day is red. So it doesn't actually confirm it. And then you get that again. Red, star, and green, and here it confirms. So that's the basic difference, just as an FYI. Stops should be below 1268. That is this low right here. We will look to track that stop and trail that stop tighter as we go into trading next week. So to kind of put it all in perspective, this is our basic outlook and forecast and really our current model. It's my current belief that we completed a wave one. This wave one would have been composed of a 5 count here. From there, we went to wave two. I believe that wave two was probably composed of A, our B, and I believe we've probably concluded our C at this point with, or concluded our wave two with this subcount C coming down and coming close to this 61% retracement. That's what we forecast here. We hit the lower end of what we forecast here in terms of where we thought the market was going to come up. And now we're looking for higher pricing. Now, for higher pricing, my sense is that we have probably now entered a wave three. And on this wave three, we will get really strong technical evidence that that is the case if in fact the market can come up and take out this most recent high at roughly the 1330 to 1333 area. In other words, we would get concrete proof that what we saw was an A, a B. We concluded with our C. If in fact this next rally, now this rally can have peaks and valleys, of course, but if this next rally exceeds this most recent high at 1330. That's going to be the first thing. We'll talk about the second piece of technical evidence that I would like to see, but we really need to breach this point first. Now, if that is how we see the market unfold, then what we're looking at is the beginning of some sort of a three-wave coming into play over the next, say, 2 to 4 weeks. And I believe that that might look something like this. In other words, as we came down, this is that wave 1. Wave 2 was composed of an A, B, and C. This is our wave 2, and I believe that we'll now move into a wave 3. And as I said, wave 3, if in fact we are correct, and if this model lends itself in terms of how the market actually unfolds, we will see a new high taken out when we look at the, first of all, the 1330, that's down here, but also this most recent high, and I believe this was roughly at about 1390, right in this area, the top of one. In other words, the strong rally, the dynamic $200 rally, which was the characteristics of how this market opened up at the beginning of the year. Now, the nice thing about where we are in terms of our current count, if this model pans out, is that wave 1 really is a benchmark wave. And so when we look at wave 1, it's very, very difficult to ascertain any kind of price move that we might see, because it's a benchmark and we're going to use it to forecast the rest of our model, meaning waves 2, 3, 4, and 5. And so one of the things that we look for once we have 1 in play is we look for wave 2 to move to roughly a 61% retracement. Now, we've gotten that. And wave 3 is going to run anywhere in terms of our extension, a minimum of 100% up to as high as 1.61 or 161% of that. And that's where we have come up with a couple of forecasts to where we think this market could go interim term, not short term, but interim term. Because realize this wave itself, wave 3, when you consider the time parameter in wave 1, you were looking at a period of time of roughly 2.5 months. This is a 2-day chart here, about 2.5 months for really to kind of unfold. We saw this as it moved into March, and then of course we had the primary part of April as being corrective action as we go in and approach the end of the month, which of course will fall at the end of next week. On Thursday, we have the first day of the next month. So that being said, this is a longer term outlook in terms of where we're looking for the market to go. But to give you a simple idea of where we think we could forecast this market, we need to work with a basic fib extension now that we have 2 in place. So I have done just that. I've added a Fibonacci extension, and the basic way that we enter that into the market, we take a look at our primary move that we saw in wave 1. We then take this range, meaning from 1183, 1391, and we then extend that, but our fixed point is the conclusion or the bottom terminating C wave. When we do that, we get a fib extension. You can see that here, and we'll have to kind of compress the range in this chart to show where it is forecasting we could go. And of course, these kind of scrunch in. But to give you an idea of what we're looking at in terms of price parameter, we take our extension, we begin it from the bottom here. I've got it fixed at 1270. 100% extension takes you roughly to 1477. So what that means is if we are in fact correct, and if we have entered a impulse wave of wave 3 cannot be the shortest of any of the impulse waves. We had a $200 move here. We should see a $200 move in this current wave. Now, realize traders, when I talk about this wave, I'm not talking about a straight rise up. It should be a series of waves, and it will probably be something like a 5 count following the same model that we always use. But this is really what we believe in terms of a potential target. This is what we think we could see. Now, there's one more piece of the puzzle that I would really like to see taken out before we start kind of banging the bell here, thinking we're going to go to this higher ground, because we've only received beginning confirmation. We've gotten some sort of confirmation that we've hit a tentative bottom, but whether or not we're back into an impulse phase of this market is still to be determined. One of the things we like to use, of course, is the cascading channel lines that you can create with an Andrews pitch. And that is precisely the chart that I brought up. As you know, we have been really watching the 23% prong and this outer zero prong. It's a zero prong that's going to really give us that information. We got our first insight that something was different because for the first time since we put this chart together, we actually exceeded that. But that was to be obviously very, very short-lived. Market comes down, tests 23%, begins to move back up, comes about halfway, then moves back down. The key is this. We need to see the market cross this threshold right here, because crossing this threshold not only on a closing basis, but watching it actually move substantially away, not like what we saw right here, but doing that gives us some fairly solid technical evidence that the market that we've been witnessing as a dramatic downtrend, this market moving from 1800 here to these lows here at about 1180, that is something that A, we've weathered, B, is in the past, and C, we can look for higher pricing. But until we really get to this point, traders, I am bullish. However, I am bullish with the caveat that we really need to see this occur. So what about silver? As you know, we'll typically go long silver when we go long gold, looking for silver to kind of move on the shirt tails if we've got some momentum being built. Silver has been lackluster, to say the least. It's been trading in this defined range here. Then it moves down to a lower defined range. It looks as though it is kind of moved back up in here. I purposely did not recommend entering a long silver trade as we entered the gold trade. And in fact, my recommendation is for those that trade silver on this particular activity or this particular time, you might want to consider moving money that you had earmarked to trade silver with, or to invest in silver, I should say, to move that into gold. And why am I saying that? Fundamentally, gold is acting as a safe haven investment. The premium that we saw enter the market and the premium that we saw erode from the market was safe haven based as geopolitical uncertainties grew, and then with the accord waned, and then of course as the markets moved up in gold, as the belief is that that accord is really falling apart. We're not seeing that same activity in silver, one. And the second reason that I would kind of shy away from silver right now, or move that, I shouldn't say shy away, but kind of transfer that investment capital into gold, is that silver is an industrial metal. We saw the equities markets under pressure. The fear, of course, is that we're in a global economy. If Russia is affected in terms of their economic stance, if we begin to put restraints and really target Russia in terms of trying to have them act a little bit differently, and do that by creating economic hazards for them, that could have a dramatic effect not only on their market. Their market, I believe, is down 22% on the year, but it could also have a dramatic effect on global equity markets. And the industrial component of silver really doesn't lend itself, of course, to equities markets globally under pressure. So for that reason, we've stood on the sidelines. Traders, stay long our gold through the weekend. We'll look to see what we want to do with our stops come Monday and Tuesday. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.